We are right on time, so here's what I'm going to do without any further delay. Peter, thank you also for checking in London. I appreciate that. I'm going to go ahead and make our connection right now, okay, to our first presenter, Barry Burns from Top Dog Trading. I got to do a couple of clicks here on my screen so that I can give him the power of the screen. And once that happens, you're going to hear his voice, and then we are off to the races. So let me go ahead and make him a presenter. Click, verify, yes. And the screen should have just changed. Now he will bring up his slides, and Barry will take the ball from here. Barry, if you can hear me, go ahead and check in with me verbally.
All right, my friend,
Perfect.
I can hear you.
We got a big group today, Barry, and they are waiting with bated breath. So it's good to have you aboard. I appreciate that you're here. We're off to the races. Thanks again for being here, everybody. Barry Burns.
All right, thank you, Joe. Much appreciated. I'm excited to be here too. And yeah, I've got a great presentation for you. It's going to be a little different than things you've probably seen before, but hey, that's a good thing. So let's get it going. All right. Oh, Joe, let me ask you real quick here. I just want to make sure that since I'm the first presenter and everything, I want to keep us on schedule. Exactly what time should I be done so that we leave enough time for switching over to the next presenter?
11:45.
11:45. Okay, awesome. Perfect. Good. I will watch the clock like a hawk. Thank you for that. All right, so as you can see there, my friends, with the first slide, solving your trading psychology challenges. One of the things that we hear about a lot are fundamentals of markets, chart patterns, and all that stuff is great and is obviously very important, very helpful. But after you figure all that out and you have a profitable methodology, then it's interesting that still a lot of people have trouble making money. And the final stop on the process or on the road to becoming a profitable trader seems to be between your own ears. What's going on in your head? And I know because guess what? I've struggled with this as well. I think every trader does. So really, when it comes down to the final analysis, mastering trades is about mastering yourself. So trade mastery is self-mastery. And really, isn't that really true of mastery of everything? It always comes down to yourself. So I'm going to share with you, as I said, I've had this problem myself. So I'm going to share with you how I overcame my own psychological demons and the challenges that I had with my own brain cells in learning to manage risk and uncertainty and hesitancy and fear of missing out and all those things that we struggle with. And I'm going to make it very practical today. So I'm going to give you a couple of exercises that I did because trading psychology books are great and there's some really wonderful ones out there, some classics. Highly recommend you get some books and read them. But reading alone doesn't tend to change your behavior. We change your behavior with behavior and behaviors exercises. So I'm going to hand some to you on a silver platter here today. And these are the ones that helped me and give you some real detail on how they can help you as well. So a little bit about me. I'm the author of Trend Trading for Dummies. Again, my name is Barry Burns. I'm the owner and founder of Top Dog Trading. I've received numerous Reader's Choice Awards from Stocks and Commodities magazine. I've contributed to other authors' books as well and worked with some major companies out there. And obviously, these companies vetted me before they invited me to come and train their traders. Also, we didn't do any legal disclaimers yet, so I'll handle that. We got to do this, very important, because if our lawyers aren't happy, then ain't nobody happy. I'm not going to read through all this. I'm sure you don't want me to, but please do read it. It's a very, very important. In fact, the way to look at this is that it's not just legalese. This is where your education begins, because the powers that be, they require that we put this stuff up here, because this is where people got hurt. Right? That's why it's so important. That's why it's required. People have gotten hurt financially in the markets, and so the regulatory agencies have said, hey, warn people about this, because we see these patterns over and over and over. And so there you go. That is actually your education, and that's where it begins. Oh, also want to just offer a free service that I have, which is my Top Dog Trading podcast. It's done very well. If you like podcasts, I know I love podcasts. I listen to them in the gym while I'm driving, all that kind of stuff, and it's a pretty darn good podcast, if I must say so myself. We've gotten up to number 10 in iTunes, so got ahead of someone. I don't know who this guy is, Jim Cramer. Anybody heard of him? But anyway, we scooted ahead of him. I got to tell you, I take a little bit of pleasure in that, but I didn't do it. You guys did. Whoever is watching or listening to my podcasts, voting on it, rating it, commenting on it. So I appreciate that. But feel free to tap into that free resource. Okay, so now let's get into the psychological aspects of trading. So here is a little bit of a challenge that all of us have, right? Try to wrap your head around this. Roughly, these numbers are not exact, but about 20% of people make 80% of the money. It's called Paretos Principle. It's not even strictly applicable to trading. It applies to pretty much everything in life. So, okay, we all kind of know that. We've heard of the 80-20 rule. But in trading, we always think that we're going to be different than the masses. In other words, we're going to overcome the odds. We're going to be one of the 20%ers. And guess what? Everybody thinks that. So now here's the little screwy thing. Everyone thinks they're going to be different and better than the masses of people that they're trading against. And so therefore, guess what? Just by thinking that, now you're thinking like everybody else. And so you're thinking like the masses because the masses think that. So what do we do with that? Now, that's not just a funny little quirky thing to say. That's actually our first clue as to how to transcend that and to become one of the 20%ers. So the first thing is to acknowledge it. It's almost, well, I hate to say it, but it's almost like an AA, where step one is acknowledge I'm an alcoholic, right? And so in trading, step one is, okay, acknowledge that I'm not that special. My mindset's like everybody else. See, as human beings, we have a herd mentality because we're social beings. And that's not a bad thing. It's not a criticism. That's just who we are. So step one is to acknowledge that and say, okay, but in trading, yeah, that is a problem. And therefore, I even wrote an article about this years ago that the title of it was Good Trading Must Feel Unnatural. And again, the reason for that is because we have this herd instinct. So it's not instinctual. Successful trading is not instinctual. So how do we overcome something that's so natural to us? So we're going to use sort of a crude, if you will, biofeedback technique. In fact, a couple of them. Both of these exercises are what I would consider kind of biofeedback techniques without the technology. All right, so here is one thing that I did that really dramatically helped me. So here's exercise numero uno. And this is where I would go and attend a lot of live trading chat rooms. Now, the key with the type of trading chat room that will help you with this exercise is that you want one where it's just all amateur traders. And they're talking to each other. It's a community, right? And that's why they're usually free. So in other words, we're not talking about the kind of chat room where you have a professional trader there. Hey, those are great, right? Highly recommend those, but that's for a different purpose. That's for actually learning how to, trade from a professional, and they can be fantastic. Our purpose here is different. What we want to do is listen to the amateurs. Okay, so I'm listening to the amateurs and what they're saying. They're all talking back and forth to each other. And they're saying, oh, market's going up, and okay, so I'm going to buy, I'm going to sell, whatever they're saying to each other. And then as they're talking about what they're going to do, watch the charts in conjunction with their comments. Now, as you're doing that, remember the masses are wrong most of the time. So what you're hearing is the inner dialogue and behavior of the losers. Now, I don't use the losers in a derogatory manner. I'm just being very literal there. People are literally losing money. So they're not bad people. They're people just like me, just like you, right? We all are losers in the market when we start. So listen to the inner workings of their mind and of their emotions. and what they're thinking and look at the charts at the same time. Now, I did this. You got to do it for a while. You got to do it for a while. I did it for about 6 months. Listen to the comments, watch the charts. Listen to the comments, watch the charts. Listen to the comments, watch the charts. And what I would recognize, I'll give you a concrete example here. You start to pick up patterns, and that's why you have to do it for a while. It takes repetition because it takes time to start to see, oh, I'm seeing this pattern over and over and over and over. So here's one that I would see, just to give you something very specific. So I would see the market go up and up and up and up and up and up. And then pretty soon people start to say, oh, this thing is way overbought. Market can't go up any higher. I'm going to short here. Okay, and then they'd say they shorted. And you can probably guess what happened. Market went down a little bit, maybe a few pennies, pips, ticks, whatever. And then it shot up and took out their stop. And then they'd say, God darn it, unbelievable. Oh, wait, we're coming into, and then they always had a reason, right? They'd always have a reason for shorting. So they'd say, oh, wait, now the market's even more overbought. This thing is beyond whatever, their volatility bands, or maybe it's Fibonacci ratios, whatever it is. Oh, yeah, okay, I'm shorting here. This is a sure thing. And market might come down a smidge and then boom, shoot up, and they'd get stepped out a second time. And then they'd be like, I can't believe it. This is incredible. This is unprecedented. There's no way the market could go up any further. So always be careful whenever you hear people use the terms like there's no way or this has to. Those kind of terms just don't exist in the real market, right? That's all people imposing their opinions on the market. And yeah, that kind of certainty does not exist in the market. So then they'd find another reason. Oh, we got a cluster of resistance and a divergence on RSI or CCI or MACD or LMNOP, QRST, whatever acronym of the indicator that they're using. And man, oh yeah, they would say, okay, now for sure, the market can't go up any higher from here. This thing is so overbought, it's just ridiculous now. And guess what? The market would go higher. So I would notice this kind of thing with these overbought and oversold levels over and over and over and over and over 6 months. And I started to understand overbought, oversold. There is a concept that is legitimate, but it's not what most people think. And so I could watch that. Now, here's the thing. I would actually be pretty much agreeing with them. I'd be like, yeah, this thing is way overbought. Yeah, we do have a cluster here. Yeah, we do have a nice Fibonacci level here. You know, whatever it is. Oh, yeah, we've got a divergence there. I learned all that stuff too. I'm looking at it like, yep, they're right. We got it. And they could analyze a chart, but they couldn't make money. And so one of my mentors, Ray, old special ops guy in the Marines, he used to... his mission was to go out and free POWs. That was not fun. Eventually got caught himself and had a hell of a life. But anyway, he was a tough old guy. And he became one of my trading mentors in his 80s. I became his protege. And he's the one who kind of then put this together for me. And he said, that's called kamikaze trading. That's suicide. He said, because the dominant energy of the market is up. And when you get the dominant energy of the market up, the market is not overbought. It's all about supply demand. It's all about the order flow. It's all about the money flow. And so who cares about any of this other stuff? As long as there's an imbalance of buying and selling and it's on the buy side, the market's going to go up. And so now, as you see there, before long, you'll be able to do the reverse. So in other words, we start out by listening to their comments and then watching the chart in conjunction with their comments. Then what happens after a lot of repetition, now what I can do is I can look at the chart and I can, in my inner mind, I can hear what the losers are saying in those chat rooms. And I'm not on the chat rooms anymore. because now I've just seen the patterns so often and what the losers are saying that I can hear what they're saying in my mind. And it just is a way to reverse engineer the market, reverse engineer the losing markets. Now, you might say it's reverse psychology, and that there's something similar to that, but what it really is, it's closer to the Chinese philosophy of the iron circle. The iron circle in Chinese philosophy means that you get stuck into a thought pattern or a belief system that you cannot break out of. You can't break out of it. What you have to do is transcend it. And so that's the situation here. We cannot break out of our own instincts. So we have to transcend them. And this is one way of, again, the biofeedback. I identified with them. I said, yep, they're right. And then I saw over and over and over that it didn't make money. It lost money. And I had to come up with a new way of thinking and analyzing and even feeling. So in the famous book, Market Wizards, great book, by the way, it's a classic. If you haven't read it, I highly recommend it. Jack Schwager interviews some of the world's most successful traders, and what he was looking for was a commonality that can lead to success for others. So after he interviewed all these major traders, incredibly profitable traders, he came to the conclusion of what was common among them. And here's what he said. What set these traders apart? Most people think that winning in the market has something to do with finding the secret formula. The truth is that any common denominator among the traders I interviewed had much more to do with attitude than approach. So again, the mental game, the mental game. Now, here's my favorite trading psychology book. Might want to write this down. This is definitely a writer downer. And the irony is it's not even a trading psychology book. It's a book about gambling. And I'm not a gambler at all. I don't like gambling. I mean, I've been to Vegas. I've played around with it for entertainment purposes. I'm not a big risk taker. So I would do what you're supposed to do. Set aside a certain amount of money. For me, it was very minute, and use it for entertainment purposes. And that was it. So I do not have a gambling mentality. Never struggled with gambling. I'm not interested in learning how to become a poker player. I admire them. I actually know a guy who's a professional poker player. Incredible. But anyway, this guy, John Patrick, he's quite a character. And I was told by another trader to read this book. And so it's called Money Management for Gamblers, and he's a poker player. And so here's what he said. And this applies to trading so beautifully, even though he's talking about poker. People who are way better, and I got to warn you that he is a colorful speaker, we'll just say. Okay, so here's the quote. People that are way better educated than me rip my theories from here to Hades and back. They claim gambling is all math and statistical analysis. They will never grasp the true meaning of gambling because they have never been there. People who think that a math equation is going to give them a leg up on winning ought to have that leg whack them in the area where they sit on their brains. Told you he was a little colorful. The pros don't make mistakes. They don't have tells. Patience is a virtue. Stupidity is a one-way street to disaster. Talk is minimal, and mercy is absent. And boy, is that true in the markets. There is no mercy in the markets. I've been to Chicago Mercantile Exchange, got an apartment out there, worked with a floor trader. I've been there. I've been on the floor, and I've been in the midst of all those guys. Yeah, it is not a merciful atmosphere at all. It's dog eat dog. Make a mistake, and by the way, this emphasizes mine because we're going to talk about this here in a minute. So make a mistake, and 7 vultures circle the wagons waiting to divide the spoils. When the night is done, and you're fortunate enough to escape with a small profit, the ride home gives you only a short time to count your blessings and your money. And boy, is that true. People think you get real comfortable. You never get real comfortable, and you should never get real comfortable with trading. Trading is always about managing risk, and the risk is always there. If I had a camera that I could show you, I can't show you right now because I don't have a camera. But anyway, I literally, along these lines, I have a little calendar that I put on my wall. Every time I have a winning day, I put a green dot. Every day I have a losing day, I put a red dot. Every day I have a neutral day, I put a yellow dot. Because of just what he said. that when the night is done, so I'm taking 1 day at a time, and you're fortunate enough to escape with a small profit. That's what I focus on. Was today a winning day? The more green dots they get up there, the little stickers you get from Staples, I just put them on there. And I'm looking for those green dots. And if I get a bunch of green dots on there, then I'm golden. Right? But tomorrow's another day. And I start the next day with a clean slate. No, I don't have a lot of big confidence. I don't get too full of myself. I don't get an ego. I just say, you know what? Here we go. Brand new day. Market. And here's another saying: the market could do anything at any time. What it did yesterday has got nothing to do. Well, it might have a little bit to do, but not that much to do with what will happen today, because, hey, news can come out that's unexpected. It doesn't even have to be real news. It could be gossip, could be rumors, and the market will still react to it. And that's not even true. And then they're like, oh, well, that wasn't really true. And then the market readjusts. But at that moment, it doesn't care what the moving average is, the stochastic is, the MACD is, your Fibonacci ratios. If some dramatic gossip or rumor comes out, or real news, all that goes out the window. And that's another saying: news trumps technicals. And you got to be ready for that. You need to know how to manage your risk, how to have redundancy in your technology, how to, you got to have that broker on speed dial. You got to have hedge your positions hedged, because just because you put in a stop does not mean you're going to get filled. Right? I've been doing this for 50 years. I've had everything go wrong that could. 50 years. My dad was a stock trader, and so he started teaching me when I was 8 years old. And here on Monday, I'm going to turn 60, actually. So been doing this for a while. I've done everything wrong that you can do. I've made every mistake, and I've had everything screwy happen. So, okay. So if you're not trading well, but you have a successful methodology, let me make one thing clear. This is not a chicken and egg scenario between technical analysis or trading methodologies or probability scenarios and trading psychology. Having a probability scenario in your trading, in other words, a successful methodology, that is primary. That is more important than psychology. Because if we filter psychology down to being disciplined and keeping your rules, well, if you have a methodology that does not give you an edge and you keep the rules perfectly, you will perfectly lose money still. So primary is having a successful methodology. But if you've got that and you're still losing, it's probably because you're making mistakes. And that's why I capitalized the word mistakes on the last slide. So the second exercise is, how do we eliminate mistakes? Well, first of all, let me be very clear and very realistic. No one ever eliminates mistakes completely. No one becomes a perfect trader. Been doing this for 50 years. I am not a perfect trader. Good news is you don't have to be perfect, but you do have to reduce your mistakes dramatically. All right. I still make mistakes pretty much every day. I'll make some mistake, but that's okay. I don't have to be perfect. As long as your probabilities are there and they're good enough to allow you to make a few mistakes, you better have that, because as human beings, we're never going to be perfect. Now, here are the 10 commandments, and these 10 commandments are general rules, but we're going to translate these general 10 rules of trading into mistakes. In other words, if you don't keep it, you've made a mistake. All right, so this is how I define mistakes, as to breaking one of these 10 trading rules. Okay, get ready to write these down. So there's 1 through 5, and there's 6 through 10. Okay, got them? Good. All right, so anyway, we don't have time for me to let you write all 10 of them down. So what I'll do is I'll give them to you for free. Just send me an email, Barry@topdogtrading.com. And I will be happy to, let's see here. Actually, I think I'm going to have to ask our organizers to send that to you, because I'm not seeing where I can send it to everybody. Let's see. Double check that. Nope, I don't see where I can do that to everybody. Oh, there we go. Thank you, Joe. Appreciate that. Okay, so yeah, if you send it to Barry@topdogtraining.com. Oh, that's actually my website, Joe. Yeah, but Barry@topdogtraining.com. That's my email. Just send an email there, and we're not going to try to sell you anything. What we'll do is we'll just send you a PDF with all 10 of those trading rules, okay, and trading mistakes. Okay, so now let's get on to the second exercise. One of my favorite sayings in trading is successful trading is simply a matter of not making mistakes. In fact, I've actually got that poster on my wall. I'm looking at it right now on my wall, framed. That's how important that saying is to me. Successful trading is simply a matter of not making mistakes. I have found this to be one of the greatest truisms in my trading success. As long as I don't make mistakes, I come out ahead at the end of the day, the week, or the month. And the mistakes I refer to are those 10 commandments that we'll send to you. Okay, so now, avoiding mistakes is a matter of self-discipline. So I can't give you self-discipline. By definition, self-discipline is a gift you have to give yourself. But what I can do is give you an exercise that can help you. So let me do that right now. And by the way, I'll give you these. These are my trading logs. I'll give these to you as well. If you would like these, just request them when you send an email over to Barry@topdogtraining.com. All right, so here's my trading log. Now, you can do this whether you're a day trader or swing trader. I do both, by the way. I day trade and swing trade. So this is the primary log. So we'll spend most time on this one, and then I'll show you some of the others too. So put the date up here, fine. And by the way, everybody, well, not everybody, a lot of people have trading logs when they just type in, okay, what market they traded, when they got in, when they got out, the prices, all that kind of stuff. You don't even really need to do that because your broker can give you that data, right? So this is a little bit more. This is going to help you with your trading psychology. So the first thing we want to make sure is we know when scheduled economic reports are going to come out. Very important, again, because news trumps technicals. The market will surprise us with things sometimes, but if there's something scheduled, we want to know it, and we're going to be watching the market at that time. All right. By the way, I also encourage you to have your broker phone number on here somewhere, and just print it right on there, and then have it on speed dial in case anything when something goes wrong. You notice I also put my slogan right there, so it's in front of my eyes every single day. Okay, so here's when I enter the time, which market, price, stop, targets, exits, okay, all that stuff. Now, so that's cool, but here is the biofeedback part of it. So here you see the notes section. Now, what I'm going to put in there are two things. I'm just going to put T. What I was thinking and what I was feeling when I took the trade. And that's at the time of taking the trade, the time of entering the trade, not after I'm in, not when I get out. You can add that too if you want to. But the most important part is during your entry, what was I thinking? What was I feeling? Muy importante. We'll come back to why that's so important. But basically, we want to create another type of chart, if you will. So we trade the charts of the price action, but then we also need to put together a chart of our mind action, our mental action. And that chart is going to be a pattern. You're going to, again, be looking for patterns. So now, just like we did in the chat room, where we were looking for patterns of what other people were saying, thinking, feeling, and doing, and then looking at the chart in conjunction, now we're going to do it with ourselves. And so I'm going to look for patterns where I might say, oh, when I entered this trade, I was thinking this is overbought. We'll use that example again. Okay, and maybe on the next trade, I was thinking it was overbought. On the next trade, same thing. And I find out, oh my gosh, every time I think it's overbought, the market keeps going up. There's a pattern there. Now I can reverse engineer that. And then after the pattern is set and I start to recognize it, and it really sinks in by watching so many times that, hey, every time I think this, or 90% of the time I think it's overbought, it keeps going up. Then when I go to take another trade and I'm thinking, oh, I think this is overbought, I'm going to like stop myself and say, wait a minute. I know I have this thought pattern. When I think it's overbought, it usually goes up. And so that becomes almost another signal, becomes another part of my trading methodology, not just the chart, but now I have some rules based on my own thought patterns, that rules that work, rules that don't work. And I find out, oh, maybe this is one rule that isn't working for me. This thought pattern is not working. But I want to recognize that and then respond. Same thing with feeling. How am I feeling? Now I'm feeling pretty anxious about this one. Maybe on the next trade, feeling anxious about this one. Maybe it's anxiety. Maybe it's confidence. Maybe it's just the opposite. I feel really confident. Oh yeah, this has to win. I'm 100% sure. I feel really confident. And whenever you feel 100% sure, it doesn't work out. Or maybe it does. For me, now in my trading, I've evolved over the years, thankfully. We all should. God help you if you don't evolve, right? Right now, in my trading, when I have the feeling that I'm very, very confident, I'm usually right. But that's because I've made all these adjustments over the years. And so now I know it works. And so when I get a setup that fits my parameters, I feel very confident about that. And yeah, because it works. And so now that's changed for me. When I used to be super confident, I'd usually lose. Now, when I feel super confident, I usually win. And so I look for that. I not only with all my indicators, whatever I'm looking for with my technical rules, I also check in to my gut, because my gut used to always be wrong, or 90% of the time was wrong, right? 80-20 rule again. And because trading is counterintuitive, it goes against our instincts. But I've retrained myself. I have, as we talked about the iron circle, I've transcended that herd instinct when it comes to trading, so that now I can trade with confidence. But it's only because I've gone through this exercise a million times to overcome my natural instincts. Okay, so we write that, and we just keep writing them every single day, every single trade, every single week, every single month, until you get enough data to provide clear patterns for yourself. Then over here in this is the other unique square. And here's where I write any mistakes that I made on the trade. Now, the mistakes would be the violation of the 10 commandments. So maybe I didn't let my winners run enough. Okay, I got out too early, got out too early on this one, and I start to see that's a pattern. I'm always getting out of these trades too early. So this is kind of a intermediary problem. At first, you're just trying to get some winners. And then you get to the next level of trading where, oh, okay, I'm starting to get some winners, but I'm keeping my winners too small. I'm not letting them run. They could be better. I could get a better reward to risk ratio. And then the next evolution is, okay, I got a good win-loss ratio, got a good win-loss ratio, and then a good reward to risk ratio, because now I've learned ways of creating better targets and trailing stops and all that sort of thing. So maybe that's your problem. So then you start to see that. And when you see that, oh, I'm getting out too soon. Now, if it only happens, let's be very clear, if it only happens once in a month, it means nothing. Right? We're never going to be perfect. And even the statistical probabilities, just because you think you got out of a trade too soon, who's to say you did? The only time you get out of a trade too soon, literally, is when the odds were still on your side for it to keep going. Just because the market did keep going does not mean you should have stayed in. So we're not fortune tellers here. We don't have crystal balls. So we don't know what the market's going to do in the future. So you cannot gauge this by, oh, the market kept going, therefore I should have stayed in. That's not the way to evaluate that. The way to evaluate it is, was there still a high probability the market would continue to go and I got out anyway? Then it's a mistake. All right. Or maybe, other mistakes are, well, I keep getting stopped out. Over and over. Okay, well, that tells you something else. Now you see a pattern. I'm either getting in too early, or I got to learn how to time my entries. I need some sort of timing indication, timing indicator or pattern that's more reliable, because I'm just, yeah, I haven't learned this yet. I haven't even come close to master it. So now I need to go and to search out the information on how to time my entries with precision. So can be all sorts of different things. Now, what we do is after we get done with the days, we'll transfer it over to a weekly trading log. This weekly trading log, so here we got it for the week. Okay, so for this week, it would be for January 21st through the 25th. Okay. And so here we take each day's data. So there you've got your dates. So I put in Monday there, Tuesday there, Wednesday there, Thursday there, Friday there. And now I'm gathering stats, cumulative stats. So how many winners did I have? Let's say I had 5 winners, and let's say I had 2 losses. Okay, and then the total profits. So the winners added up to how much dollar amount. And then the losses added up to how much dollar amount. And then the average dollar amount win, the average dollar amount loss. Now, this is key. This is key. So many people will tell you, oh, you should never take a trade that has a worse than 1 to 3 risk reward ratio or something like that, 1 to 5, 1 to 4, whatever they're going to tell you. And that's all great in theory. I'm not arguing it. But what I am saying is you can start with that theory. In fact, it's great to start with that theory. That's a good idea. But this is going to be your reality. So when you look at this difference here, this at the end of the week, when you add all this together right here, this one is going to give you your win-loss ratio at the end of the week. This one is going to give you what your real risk-reward ratio is, what you traded. So win-loss, risk-reward. And then you're going to say, okay, well, but wait, I was only taking trades that had a 1 to 3 risk-reward ratio. That was it in theory, but it didn't work out in reality. So now you've got to make adjustments and go back and review your trades. I actually like to, here's another little extra tip for you. I know this sounds kind of old-fashioned. I used to think it was too, but again, my friend Ray, he's a good old guy. He was in his 80s when he was teaching me. And he told me, Barry, he said, you got to print out your charts. Print out your charts when you review your day. And I thought he was full of humbug, to use his term. And because I just look at the charts on the monitor, right? And I can review my day on my monitor. And he would get really mad. I told you he was a gruff old guy. Heart of gold, but tough. And he was at the age where I don't think Ray ever cared about what anybody thought of him anyway. But as he got older, he got even more gruff. And I just thought, he wanted me to print out the charts because he was old and he wasn't used to technology. And he said, nope, that's not it. That's not it. You got to print them out. You got to see it on paper. You got to hold it in your hands, and then you got to draw on them and all this kind of stuff. Well, at that point, Ray was teaching me for free. So, I had paid him mentoring, thousands of dollars for mentoring, but he eventually brought me into his inner circle. I actually used to go to trade at his house with him and his 40-year-old girlfriend. And so, we became friends. And so he wasn't charging me. So I'm like, okay, do what Ray says. Do what Ray says. And so I did. It took a while too. I'll tell you, I resisted it because I really didn't see the value in it. Honestly didn't. So I started printing out my charts. God darn it, if Ray wasn't right. It changed my trading. That simple, stupid little exercise of printing my charts out on paper and then going through every trade and having these trading logs there, and then having the charts on print and then lining up and drawing vertical lines across multiple time frames and doing all that extra work. That analog manual labor, if you will, it changed my trading. It took my trading to the next level. I saw things different than I saw when I looked at it on a monitor. I don't know if it was just, I think, part of it, I think it was slowing me down. I think it was making me slow down and analyze it in more detail. On the monitors, I'd go through it kind of quick. I think maybe that was part of it. Anyway, whatever it all was, man, they worked like a charm. So I share that with you. And I know it's not the shiny object. It's not the cool tip or hack, that we all look for. But some of this old school stuff really works, and I'm just telling you, it's one of them. It's up to you whether you want to do it. It reminds me of an old, one of my favorite quotes of all time is from A.L. Williams, who built the largest insurance company in the world. And he said, successful people do what unsuccessful people are unwilling to do. It's not that they can't do it. Notice the words used there, very important. Successful people do what unsuccessful people are unwilling to do. So we all can print out our charts. I was unwilling to do it for a while. When I finally became willing, took my trading to the next level. I mean, crazy. In fact, I will tell you, doing this process of these trading logs, this is the one thing I've seen, and printing out the charts and doing all this labor, it is the thing I've seen turn more traders from non-profitable to profitable than anything else, more than indicators, more than, fancy moving averages or whatever. And all that stuff's important. But when it comes down to the final wire of turning people's trading around, this is what I've seen do it in the final analysis. And by the way, one last thing on this, and then we've just got one slide left. So not only are you keeping track of your win-loss ratio and your own real reward-to-risk ratio, then you add your commissions in here, because remember, you got expenses. This is a business. You got expenses. And then the profit and loss percentage of your account, and this is really important for me. I have a amount that I will risk per trade, okay? And that's 1/2 of 1%. That's my maximum risk per trade. And then maximum risk per day. So you better make sure that if you lost that day, that meets your rule that, okay, I'm not allowing myself to lose more than this percentage of my account today. This is part of your money management. How many mistakes did I make that day? Now, here's the real key. This is where it's so cool. Oh, by the way, I'll go skip over here. Then you write down your mistakes. Now, you don't write down every single one. What you do is you write down every one, but then you say like, okay, 5 times I didn't let my winners run. 2 times I got in too early. 3 times I got in too late. 1 time I missed a trade. Okay, missing a trade is a mistake, by the way. Missed opportunity. So you look for this, and then let's say you missed a trade once here, but I missed trades 5 times this day, and I missed trades 3 times this day, and missed trades 4 times this day. So you add all these up, and now down here, you look for the pattern. And if you only made it 1 mistake the whole week, I just discount it, whatever. Okay, I notice it, but fine, human error. But I look for the mistakes I make the most often. Again, we're looking for the patterns, and this is going to be very personalized to you. Your challenges will be different than my challenges, which will be different than somebody else's challenges. And our patterns and our mistakes and our behaviors. So you look for your most common mistakes, and then you start with that one and you work on turning that one around. And then when you fix that one, you go to the next. Fix that one, go to the next. Fix that one, go to the next. So pretty soon, you become a trader who isn't making mistakes. Remember, successful trader or successful trading is simply a matter of not making mistakes. And this is how you fix it. And one last little tip to help you with the motivation of it, because sometimes people say, well, I see them, but I don't know how to change them. The spirit is willing, but the flesh is weak. So this is where this final column comes in. You write down here and you calculate, well, if I didn't make any of these mistakes, how much money would I have made? How much money would I have made? Okay, and then you compare this column. And so what you'll often find is here, you'll be making money. And then if I look over here, okay, then maybe you lost money. And you see this happen day after day after day. Compare those columns. And you say, guess what? And I've seen this with so many traders. God darn it. I am already a profitable trader. I'm a profitable trader right now, today, this minute, if I just stop making these darn mistakes. And that is often enough motivation to get people to change their behavior and to change these. So that column is the one that you use to create the change, to motivate yourself to stop making the mistakes. Okay, so here is my final slide. Here's how to get in contact with me. Here's what I'm offering today. Again, I don't really have anything for sale, which is kind of ridiculous. But anyway, I don't. So what I do have for you is a little mini course that'll actually give you for free. How's that? Instead of buying a course, why don't you just get one of my free courses here today? I kind of dropped the ball. I should have brought something to sell you, but I didn't. So anyway, that's to your benefit. So I'll put the link in here, and maybe Joe can repost that for me. I appreciate that. So there's the link. It's topdogtrading.com/free. And when you go there, here's what you're going to get today. My little mini course, and what this is 5 days of professional videos. These are about 20-minute videos, quick little lessons, lesson each day, an interactive quiz at the end so that you'll know if you got the lesson or not. One of my favorite trade setups is there. So this is not just education. I'm actually going to give you an actual trade you can start trading called the rubber band trade. Gives you all the rules, the filters, everything. And then also I'll show you how to get my personal cycle indicator to time your entries with precision. So all that absolutely free, topdogtrading.com/free. And my gift to you. So that's it. I went 1 minute over. Sorry for that. Joe, thank you so much. Appreciate you hosting this. Appreciate Investor Inspiration. Appreciate you guys hosting this entire event. Thank you so much. And thank you to everybody for showing up today. Hope you enjoyed the presentation.